So like we are into the capital structure and solvency ratios. Okay. So capital structure and solvency ratios would guide you like how your capital structure should be. Okay, it guides you how your capital structure should be. That means this is your balance sheet, and this is your total of assets, and this is your total of equity and liabilities. Okay, some
Mm.
X amount, both should be equal. So this,
Mm.
why are we like studying these ratios, or what how these ratios guide us, or on what, in what way they guide us? They guide us uh, like uh, like if you have a capital structure in your business, see, you have your capital in two ways, that is equity and debt, and again debt is again divided into long term debt and
Mm.
short term debt. Okay,
Mm.
so the first ratio, if you see, debt to equity, very simple. They very simply what they are doing with this ratio is they are taking total liabilities and they are comparing the total liabilities with total equity. That means they are seeing, if this is 10 lakhs, let's say, how much? 10
Mm.
lakhs.
10 lakh.
And yeah, and your total equity is, let's say, 4 times, and your total liabilities, let's say, total equity is 4 lakhs, and your total debt, I'm speaking about, when I speak about total liabilities, I speak about long term liabilities and short term liabilities.
Come.
Let's say it is 6 lakhs. What does it show? 6 by 4. It shows that your total debt is 1.5 times of your equity. Am I correct? Am I right?
Right. Mm.
Okay, isn't it so? It is 1.5 times
Yeah.
of our equity. So
Okay. Mm.
in the debt to equity, total liabilities include liability, all liabilities, that is long term liabilities and
Short
short
term.
term liabilities, and
Mm.
equity consists of shareholders equity, that is
Mm.
equity. Shareholders equity is nothing but common equity and preferred equity. What is that?
Mm. Common
Common,
and
that
both.
is equity shares
Correct.
and preference shares. Yeah. So a debt to equity ratio of 2 is to 1. So in our case we got 1.5 is to 1, correct?
Mm. Right.
Let's say our equity is 2 lakhs, our total liabilities, let's say, like we took this 6 lakhs now. If we would have taken let's say 3 and 7, it is, if it is like, let's say this is like it's like, let's say it is 3 lakhs. For example, it is 3 lakhs, equity is 3 lakhs, and your debt is 7 lakhs. How much?
7 lakh.
So 7 by 3 gives you 2.33. That is almost 2, correct? Correct? See,
Right.
if it is 2.5 or more than 2.5, I can take 3. If it is less than 2.5, it is between 2 and 2.5, I can take 2. Okay, this will
Right.
be more, it will be given more weightage. So
Mm.
a
Mm.
ratio of 2 is to 1 is a very ideal debt to equity or total liabilities to total equity ratio. That means your total liabilities when compared to your equity can be 2 times but not more than that. It is very dangerous. Understood?
Okay.
Why it is dangerous? See, debt is a cheaper source of finance. I understand. Debt is very easily available kind of finance. I agree that. But debt is very riskier form of finance. Why it is riskier form of finance? See, debt to a certain level is always acceptable, but beyond a certain level, what happens if you don't perform constantly, or if you don't generate good amount of revenues, then your business
Right.
becomes more and more debt ridden, correct? And
The
that,
total liability can't be more than total equity, right? It shouldn't
no,
be
no, no,
more.
see, total debt is 2, suppose $2, and
Mm.
total equity, what the contribution what you have put in the business is $1. That means you
Mm.
raised a capital of you raised your capital, correct, in the form of debt and equity. This is your
Mm.
own contribution, this is you borrowed. So what they're saying is, whatever you contributed, you can borrow twice of that, but not more than that, correct?
Mm. Mm. Mm.
Just a second, Suman, just a second. हेलो शिवाना, हेलो, हाँ शिवाना, बोलो बोलो बोलो। हाँ हाँ, वो उसको ऑडिट का किट दे दो ना। ठीक है ना, उसको दे दो। ओके ना। अच्छा, मैं आपको जब ये 2 बुक्स भेजा ना, कौन सा भेजा? एक F7 का टेक्स्ट भेजा और एक hello.
Yeah, sir.
Yes, ma'am. So what I'm saying is, see, when you do a business, it is you may have a requirement, you may have some requirement of money. So it is not always necessary that you can put everything from your pockets, correct? Every person in the world, like if you take Ambani or any company which is running in the world, okay,
Mm.
if suppose it's a private company, so do you think can you invest the entire capital always from your pockets? See, everyone would like to keep some reserves with them also, correct?
Correct, correct.
That means you have to borrow, of course, and
Mm.
you can easily borrow from the market. Banks are available for you. You can raise funds by issuing bonds to public. There are various other ways to borrow. So when you borrow money from people, okay,
Mm.
then definitely it becomes a liability for you. So do you want more and more liabilities in your business? Do you want to increase more and more liabilities in your business?
No, no.
You want to keep it at certain level, no? You want to keep it
Right,
balanced, isn't it so?
right.
So what they're saying is, if $1 you are contributing in your business, and $2 if you are borrowing from outside, and this borrowing, what I'm saying is not only long-term borrowing, it is also short-term. It also includes short-term borrowing. That means, you see,
Mm.
this is the balance sheet. In this, I'm speaking about this entire section. Okay,
Mm.
I'm
Mm.
speaking about this entire section, and in this, if I give division, this is just equity and this is debt. And here,
Mm.
equity, I'm saying you have $1, and debt, I'm saying you have $2. Let's say, like long term debt is $1.5 and short term debt is $0.5, correct? So that makes it
Mm.
$2.
Mm.
Okay, then this
Right.
completely is $3, isn't it? So the balance sheet liabilities and equity side total, and the total of assets is $3, correct?
Mm.
So
Right.
what do you understand by this? You understand is your total liability is twice of your equity, and that is acceptable. If the total liabilities are more than this 2:1. That means if it is 3:1, then it is dangerous for your business, not good for your business. Why? Because your liabilities are increasing now. And then you have to be a constant performer, and the pressure will always be on you. See, you even earn, okay, and you also draw your salaries. But do you want your credit card to be your credit cards, whatever you use, you swipe, or whatever you buy it like, see, I have a credit card of 3 lakh rupees limit. So, and whatever I earn, shall I just swipe 3 lakhs immediately and create a liability? No, I know that whatever I earn, okay, of that, suppose if I earn, let's say 1 lakh rupees per month, let's say, so I would like to keep my liability limited, not 3 lakhs, correct?
True.
I cannot keep my liabilities to an extent of 3 lakhs. That's not good for my business. What I can do is, I can just, if I have a business and if I contribute 1 lakh, and if I like create a liability of 2 lakh, then it's still manageable for me, because I'm speaking about total liability. Short-term liabilities I have to repay within 1 month, 2 months, or 3 months. And long-term liabilities I still have time to repay in 4 or 5 years or 10 years of time. Correct?
Correct.
So if this increases to 3 lakhs, 4 lakhs, 5 lakhs, 6 lakhs, or 10 lakhs, then what happens? You are always in pressure, and then your business has to do exceptionally well. Never ever it should have any kind of such months or such duration whereby they are not able to generate good revenues, or they are not able to search good customers, or crack good deals. They have to at any cost perform. They have to do that. Understood?
Correct.
If they don't perform even a little, if their performance level is going down, see, their performance level should be up. If it is going down, slightly down, then again the pressure would mount on them. So if you have higher liabilities, you always feel pressurized. And what happens if you have more and more liabilities? Until and unless you repay the old one, the new ones would not give you loans,
Correct.
and the old ones would keep lot of restrictive conditions on you, that you cannot borrow more until unless you repay us. Okay, so now what happens?
Right.
You have a lot of stress in your business, and no one would like to create such kind of stress. Okay, so that's the reason why they say it is okay if you have this ratio, but if you go beyond that 3:1, 4:1, then it is very dangerous, ultimately dangerous levels. You are like you are breaching this standard, and you are going into danger zone. Correct? That's what. Okay. That is what is the explanation regarding this debt to equity. If you want, you can write down this ratio, or else I'll move forward. You can like,
Forward.
yeah,
Yeah.
yeah. Now the next ratio is nothing but, it's not total debt by total equity. It is just long term debt by equity. Okay. So I have like, when I speak about total debts, I speak about long-term debt and short-term debt. But here I am removing this one, and I'm taking only this one. Fine.
Okay.
So then what happens? What is the ideal ratio? 1:1. That means if you have an equity of 1 lakh and if you have a debt of 1 lakh, your ratio is nothing but 1:1. Correct? It's like 50-50.
Right. Right. 50-50.
Yeah, so what happens in this case is, this is a very ideal ratio. That means your long-term equity and your long-term debt are almost equal. That creates a very good balance, isn't it so?
Right.
Now assume if your long-term debt goes to 70% and your equity is 30%, then what happens? It's dangerous or less dangerous?
Yeah, it is dangerous.
See what happens if your debt and equity are 50%, 50%. Then what happens? Like, your business, the capital structure what you have is completely balanced. Okay, so more equity is also not good, more debt is also not good. See, if you are having tea, do you think more sugar is good for you?
No.
No, that's not good, because like, people cannot, excess of sugar would make the tea more and more sweeter. It's hard to
Correct.
consume, and less sugar also is not good, because it won't give you that taste. So that's what we say.
Correct.
A standard measurement, a standard quantity of sugar is required for 1 cup of tea, isn't it so? In the
Right.
same way, more salt is not good, less salt is not is not giving you great taste. So things should be very balanced. So in the same way, if I replicate the concept here, your capital structure should be thoroughly balanced. Okay, so if the equity is more, what happens? The equity holders become more dominant in a public company, and they always try to
Right.
influence the company's directors decisions. They try to superimpose their opinions and viewpoints, okay, on directors, and that becomes a tough task for a director to run the company. If you so
Okay.
that's the reason why we say 50% equity. If you have excess
Hmm.
debts, that's also not good, because they'll restrict you, and they'll not allow you to take more and more loans. Okay, if you
Hmm.
have a requirement, they put a lot of restrictions on you. We call them covenants. Covenants are nothing but restrictions. So excess of
Hmm.
debt is also not good. If you have more equity, let's say, then more dilution of EPS, correct?
Uh,
Isn't it so? You have to share the profits amongst more people now, correct? If you are raising further equity. So all these are
hmm.
the problems. So that's the reason why it is better to keep it in a balanced way. That is 1:1.
And when do we calculate all or analyze all these ratios?
Sorry.
In which
When
in
we
which
will see, if you want to
in
invest in a company, you want to check the company's solvency position, correct?
hmm, hmm, hmm,
Long-term liquidity or solvency. How solvent is the company? If the debts are very, very high, do you think the
hmm.
company would be more solvent, or it is moving towards insolvency? Because more
Moving.
debts, more debts, less profits, less revenues, not able to pay to. So what happens if the revenues are less, the profits would be less. The profits would be less. The business would be not running itself very confidently. Okay, and if at all less profits are okay, manageable, but one or two
Hmm,
spells whereby you incur losses and you have high debts, then you are moving
hmm.
towards bankruptcy, isn't it so?
Correct.
Insolvency, that's what. Yeah. Next is debt to assets ratio. So we have already discussed about this. Like in the balance sheet, this is like 10 lakhs is your total of assets, and this is your 10 lakhs is like total of liabilities plus equity. Okay, this is like 10 lakhs. So let's say your total liabilities is 10 lakhs. Okay,
Hmm.
total liabilities. Okay, no, not total liabilities. Equities, let's say 4 lakhs, and your total liabilities is 6 lakhs. That is total liabilities, long term debt and short term debt,
Hmm.
correct? So I
Right.
have taken 6 lakhs, and your total assets are, let's say, 10 lakhs. Total assets is nothing but non current assets and current assets both. Okay, so what do you
Okay.
understand by this? Your assets have been funded by 60% debt. That means 40% of your assets are funded by
Equity.
equity. Understood?
Hmm.
Yeah. Now please see look into these ratios. We'll move forward.
So total assets will be always more than this total liabilities, right?
See, I already told you this liabilities section is not only about total liabilities. It is total liabilities and equity.
The both. Huh.
Yeah, if you combine these both, then you get the liabilities side. So I am not taking this part, I am just taking this
Hmm.
part, and it is easily understood that this is 60% of your total assets and this is 40%. Understood? Fine. So why we see this ratio? We see this ratio to see how the company has purchased all its assets. It has borrowed less or it has borrowed more. Are you understanding what I'm saying?
Mm-hmm. Mm-hmm.
So what does it show? The company has borrowed like 60. See, 60% of the assets are funded by debt finance. That means the borrowings are way more than the equity. How much it is way more? 6 by 4, 1.5
Hmm.
times. Correct? That's still manageable,
Right.
because 2
Hmm.
is to 1 also is still manageable. But if like
Hmm.
your ratio is like your debt is like total liabilities is 8 lakhs and your equity is 2 lakhs, then your ratio is 4
Hmm.
is to 1. It is not manageable. Correct?
Hmm.
That means 80% of your assets are funded by debt and 20% equity. It's like you're playing with fire. It's dangerous.
Hmm.
Got my point?
Right. Right.
Yeah.
Right.
Yeah. See, always if a businessman has to have peace of mind, then
Hmm.
he should restrict himself with this ratio. That means he should, like, whatever the debt and equity he has in the business, it should be in the ratio of 2:1. Like I took 7
Correct.
lakhs and 3 lakhs, na? That was like 2.33. It was a good ratio. Understood?
Mm.
Now they
Mm-hmm.
should not allow it to go more than this, like 8 lakhs and 2 lakhs. That would be dangerous, or 9 lakhs and 1 lakhs. That's dangerous. Understood?
Okay.
Yeah.
All right. So here also the ideal ratio should be 2:1, na?
Yeah, 2:1 is always the ideal ratio for debt to equity. Here we are seeing the funding, how the funding has happened.
Mm.
See, your assets should be like your assets are financed by credit. See, your assets can be financed in two ways. One is your own contribution and one is from your creditors. Okay. So how much of your assets are funded or financed by the creditors is what we are seeing. So what we saw, 60% of the assets are funded by the creditors. That means
Mm.
40% is your own contribution. Correct.
Right.
That's one. That's one.
Got it. We can move forward, sir. We have this in textbook. I'm
Yeah.
making a note.
Now is like earning coverage ratios. See, I think we have done this interest coverage ratio once. Check it out, Suman.
Interest coverage ratio, we haven't done it separately.
No, I think we have already finished. If you can check it once. Interest coverage ratio, fixed charge coverage ratio.
No, sir.
We have not done.
No, no, no. We are going step by step, one by one, one after one.
No, we have done like we haven't done.
Price earning किया था. We have done that thing. Market and price.
Uh-huh. Okay. So I'm thinking like just a second. Okay, if it's not done, then we'll do it.
Yeah.
See. So now next part is like interest coverage ratio. So it is also called as times interest earned. Okay. So the formula is PBIT, or you can say EBIT, by interest expense.
Interesting.
Okay. So this is the ratio. Fine. So see, PBIT is also called as operating profit. You know this, no?
Mm-hmm.
Already we have discussed while doing the income statement, correct?
Yeah, yeah.
So what this ratio mean? See, you will pay the interest to bond holders or the banks from which you have borrowed out of your operating income. Isn't it so?
Yeah. Mm.
See, until and unless you get your operating income, can you how will you repay them? To repay
Uh,
to the bond holders or to repay to the banks from whom you have taken loans, you should first get your operating income. So when we remove
correct.
interest from our operating income, PBIT minus interest, then we get what? PBT, correct?
Mm-hmm.
Then we pay taxes, we get PAT. Am I right or wrong? Is it so?
Yes, yes, we have done
Yeah,
this.
yeah. So we have done. Sorry, you understood, no?
Yeah, that, I mean, I have understood because this was been explained previously in while calculating the EBIT.
Yeah. So let's say your EBIT is $100,000 and your interest expense is 10,000. What does it mean? Your company has 10 times the
Mm.
capacity to pay this fixed interest charges. That means your company has earned how much? See how much you are supposed to pay, how much interest you are supposed to pay to the debt holders. $10,000, correct?
But
Hello.
we have earned 10 times more.
10 times more. You have 10 times the capacity to repay, to pay the interest to the debt holders. That means your earnings have been $100,000 and your interest what you're supposed to pay is $10,000. That means how much capacity you have to pay this? You have 10 times the
10.
capacity, no?
Got it. Mm.
Yeah, like you can make the payment 10 times. If it is like 80,000 by 10,000, then you have 8 times the capacity to pay the interest to the bondholders,
Mm.
correct? So suppose
Correct.
if I want to lend money to a company, I would check what is its capacity to pay interest. So here 10 times and
Correct.
8 times is a great capacity, understood?
Mm.
So
Right.
6 to 8 is considered ideal. You can make a note of this ratio.
6 to 8.
Yeah.
Okay. All right. We can go forward, sir.
Hello. Yes, Suman. Did you note?
Yes. Yeah.
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 Yeah. Yeah. Next one, fixed charge coverage ratio.
Mm.
Fixed charge coverage ratio. So the formula is earning before fixed charges and taxes by fixed charges. Okay. Previous ratio was earning before interest and tax. Now it is earning before fixed charges and taxes. Correct?
Mm. Got it.
Hello.
Yes, sir. Got it.
Yeah. So now, see, interest is also a fixed payment. Of course, you pay fixed interest. Okay. But apart from interest, there are certain other fixed payments also. What you do to your, what you do, or there are some fixed obligations you may have apart from interest.
Mm.
Okay. So what are those fixed
Okay.
charges which you have to pay because you are contractually bound to pay, or you have a contract as per which you have to pay? So fixed charges are
Like
all
rent.
sorry.
Like rent.
Like rent, yeah, but we don't take rent here. That's not a part of this. We take leases. Okay.
Okay.
Okay. See, rent can be anything. So, see, rental agreements are not some agreements which are accepted.
Mm.
Like it doesn't bind both the parties. Fine. If you don't pay the rent, then they ask you to vacate. But in leasing and all,
Mm.
if you don't pay the lease payment, still they give you some time, and it's a long-term contract of 10 or 20 or 30
Okay.
years. Correct.
Mm. Mm.
So what happens? The other fixed charges apart from
Mm.
interest payments, what we are considering is
Mm.
lease payments. Okay,
Mm.
we will take like lease payments, even like whatever it is, if it's a operating lease
Mm.
or short-term lease payments, those are of fixed nature. Correct. So fixed
Mm.
charges are all contractually committed payments on both debt and leases. So for debt you
Mm.
pay interest, for lease you pay lease expenditure or lease rental or lease payment, whatever you want, you can say. Okay. Now, see, for any kind of debt, it is not only the interest, you also pay the principal element to them, correct? So it's like an easy monthly installment EMI. Am I speaking about EMI? EMI is a combination
Yes.
of principal and interest. Am I right? And
Yeah,
this
correct.
EMI is always a fixed like payment, na? When you pay a home loan
Right.
EMI, you pay a fixed payment, correct? So sometimes what happens, the interest increases. When the interest increases, they charge more from you by increasing the tenor, but they don't disturb this fixed payment. Understood?
Payment. Correct.
Yeah. So interest and principal payments of debt, interest and lease liability, principal payments on finance lease. So when you have taken some property on capital lease or finance lease, two things are created. You can show that lease asset in your asset side of balance sheet, and as well as you have to show your lease liability also. What is that? And
Liability
lease
also.
liability is similar to it's very similar to a loan. Okay, as you are paying a loan, in the same way you pay your lease payments. That's also a combination of principal and interest. Understood? So interest and lease. So interest you pay on what? On your outstanding liability. So did I take the interest here?
Yeah.
And then it's not only the interest what you are paying, you are also repaying the principal element, that is your lease liability, correct?
Correct.
So interest and lease liability, principal payments on finance leases. I think it's correct. It's very clear to you, correct?
Yeah, yeah, yeah.
And also, yes,
Yeah. Could you explain this lease assets again?
lease asset is nothing but the asset which you have taken on lease for 30 years or 20 years. So since you are deriving economic benefits from that, it's an asset for you. So you show it in the asset side of balance sheet.
Got it.
Okay. Even though you are not a legal owner of that asset, but you are still deriving economic benefits out of it. So you have to show that in your asset side. You are paying a rental of 20,000 per month and you are generating a revenue of 10 lakhs from your by the usage of that premise. Then who is the actual who is deriving the actual benefits? You. Correct.
Correct. So we have to show that.
Yeah, so you have to show that asset, and since it's a lease of 30 years, you are supposed to make payments to them. The asset, let's say it's a 50 lakhs asset, so that asset will be depreciating every year. Okay, your lease
Correct.
expenditure would be a combination of what? Capital cost plus finance cost. Correct? Capital cost will be the depreciation of asset. Finance cost will be the interest. Correct?
Yeah.
So suppose your payment is 50 lakhs, you are supposed to make the liability payment of 50 lakhs, and suppose it's for 30 years. So you have to go to the annuity table. Okay. So in annuity table, you have to see 30 years, and let's say 15% is what? Is the interest. Let's say. Okay. So you have to go in that table. You have to see 15% rate and 30 years in the column, and or else like 30 years here and 15% here, you'll get an annuity payment. So I think there in this or not. It's yeah, it's there. Okay. You'll get an annuity factor. That annuity factor, if you divide, you'll get the installment amount, how much you are supposed to pay. So this is the this is present value of annuity table. I'm taking 30 years. I'm taking 14%. Let's say it's 7.003. Okay. So you divide 7.003 by 50 lakhs and tell me. 7.003. 50 lakhs. Divided by 7.003.
Mm-hmm. 71397.
Yeah, so this you are supposed to pay every year this much you are supposed to pay, divided by 12. So 59,498 monthly you have to pay. Okay.
59,498.
Yeah. See what happens is like they have given yearly, na? How many installments we are paying in 30 years? 30 years is 360 installments.
Mm-hmm.
So annually you have to pay 8 lakhs. Per month you have to pay 59,000 something change. This 59,000 has principal and interest element both in that.
Contribution.
Yeah. So what happens if the first, suppose the EMI is 50,000, let's say 60,000. In that the interest element will be like 58,000 and 2,000 will be the principal element. See, they'll be charging very high interest in the initial time and very less, okay, principal. So minus 2,000 would give you 49 lakhs 98,000. So next interest would be calculated on this amount, okay. Then what happens? This your interest element will become 58,000 some change, or let's say 57,900 something like that, and your principal will become 2,100. So like that your principal start increasing, your interest start decreasing, and you'll be paying your liability in 30 years. Understood?
Yeah.
So that is
We
nothing
have
but
some this as well.
you don't have, but I'll be teaching you leasing chapter in your part 1. That time you'll be understanding this schedule. If you want, I can share videos of leasing with you if you want. If you want to go through leasing, I can share my video. There are 2 videos which I have. You can go through that chapter completely and understand this schedule, how it happens. Shall I send?
Let it go in the flow, sir.
No. See, you asked, then I reverted. Okay. If you want more clarity on this, types of leases, what is a lease, how many types of leases are there, how like operating lease, what is operating lease, what is finance lease, what is short-term lease, all the details are given. If you want more details, I'm saying I can send you. You can just WhatsApp me, like I can give you, yeah, to go through. That's it.
Okay.
So total operating and short-term lease payments, these are also of fixed nature. Okay. So finance lease is something which is for long-term. Operating or short-term lease is for very short span of time. Let's say like 1 year or 2 years. Yeah. So now what happens? EBIT was earning before interest and tax, in which interest was a fixed payment. Apart from that, we are taking what? Operating and short-term lease payments, which are also of fixed nature. And we are getting earning before fixed charges and taxes. Okay.
Right.
And like that was the numerator, and fixed charges which you are taking in the denominator. First we got the see, EBIT we already had. To that we added fixed charges. Fixed charges is nothing but operating and lease pay, operating and finance lease payments. Operating or short-term lease payments. Okay, so this was what we took. Yeah, we added this one, correct. See, operating and short-term lease payments. Then we got earning before fixed charges and tax. Then the denominator part is fixed charges. That is nothing but interest expense, whatever the fixed charges are there. That is the interest expense on loans and finance leases, interest on loan or finance lease, which is for a very long period of time. Both are very similar. Then also the principal payments, what you are paying on loan and lease liability. That is, we are taking interest plus principal, okay, plus total payments on operating and short-term leases, operating and short-term total payments. Okay, so these would all be completely the fixed charges. You can make a note of this and that as well and do a question right now. I'll be giving you.
Yeah. Okay.
PDF हाँ करा देता हूँ ठीक है PDF दूसरा चैप्टर को प्रिपेयर करके PDF ले लेना मैं कर रहा हूँ दिवाली के वजह से ओके हाँ ठीक कल लेकर ये मैं भेजा तो भेजा छोड़ देना ठीक है सुमन finished
Yes, sir.
yeah you did you note this one as well
Yes, yes. Yeah, I've
finished
made a note, sir. Yes,
yeah
sir.
so you can do this question shall I explain you
Yes, sir.
yeah so a company has outstanding loans finance leases
Mm-hmm.
operating leases and short term leases company has to pay loan to people they have taken some property on lease long term lease they have a operating lease of 4 or 5 years let's say and they have a very short term lease also okay see these are all
Mm-hmm.
new terminologies for you that's the reason why I'm saying
Mm-hmm.
if you go to my video you can understand the differences between all this okay
Okay.
so the required principal payments on its loans, see, finance lease is for a very long period of time, let's say 30 years. Operating lease
Mm.
is very similar to finance lease, but they have some differences. So in
Mm.
finance lease, you have the purchase option. You can buy the property. There are 5 conditions which a property should satisfy for it to be in finance lease. Okay, that
Okay.
means like it should be used 75% of the life suppose your lease term is 30 years so at least 25
Mm.
years you should use that property you should have a purchase option there are 5 conditions out of that if any one of the conditions are met it's a finance lease
Mm.
if those conditions are not met it's a operating lease correct
Correct. Mm.
and short term leases are nothing but you take laptop you take some bike or something you see foreigners coming India they take laptop and bikes
Mm.
on lease it's for
Mm.
a very short span of time okay
Okay.
so those
Mm.
are like petty expenses kind of you can estimate that like it's something
Mm.
for a very short span of time 2 or 3 months they just take it someone has come to India for a visit and he lost his laptop he immediately wants a laptop he doesn't want to buy so he can take that on lease now from someone
Correct.
from some
Mm.
lessor who is doing this business or from
Mm.
someone some friend or someone or some colleague so that's
Mm.
a very short term lease okay
Okay.
so the required principal payments on its loans amount to this much this is the principal element while the required lease liability payments on finance lease is 75,000 so on loan how much they have to pay 1,25,000 on loan this is
Mm.
the principal element okay loan and on lease the principal element is 75,000 correct
75,000.
and
On loan, they have.
they have to on loan they have to pay this much principal on finance lease they have to pay this much principal interest expense on
Mm.
loans and finance lease completely is 60,000 interest expense that is on loan and finance lease understood
Mm.
they did not give the division but they gave the lump sum interest lump sum amount of interest expense understood or not
So how did they calculated this EBIT, sir? Earning before interest and
I'm
taxes?
coming to
1
that.
lakh.
I'm coming to that so
Okay.
much, but I have not gone to that extent. I'm here itself. I just want you to understand whether you understood till here or not, the data.
Yes, yes,
I
yes.
want to
I
just confirm
understood
that.
it.
Yeah. So
Yeah.
interest expense on loans and finance leases are 60,000. I've written there. And the
Mm.
short-term lease payments are 45,000, correct? So they have given you EBIT already. What they gave?
EBIT, they have already mentioned it.
Yeah, so you have to just deduct they have deducted the interest expense on loans and finance leases. So they got EBT, they deducted the taxes, they got net income. Okay. But what we want for fixed charge coverage ratio, we want earning before fixed charges and taxes. So what we'll take, we will take EBIT and we'll add back the operating and short-term lease payments, 45,000, correct, as per our formula.
Right, right.
So we got EBFT, earning before fixed charges and taxes. Now we are supposed to find out the fixed charges. For that, we'll take interest expense on loan and finance leases. We'll take the principal payments on loans and finance leases, and we'll take the operating and short-term leases payments. That is how much? 45,000. Correct?
This
Three things.
required principal payment
See,
on loan and finance.
See, interest expense on loans and finance leases is how much? How much?
Yeah, that we
60,000.
have 60,000.
And then required principal payments on loans and finance lease liabilities, how much?
Here it is mentioned as 2 lakh.
2 lakhs. That is a combination of the interest what you're paying on loan and the interest you're paying on the lease liability of the finance lease. Correct? 75,000. 1,25,000 plus 75,000. Understood? This is interest on loan. This is the lease liability, interest on lease liability, correct?
Right, right.
Yeah.
Okay. Principal.
And then you have the operating and short-term leases payment. So total payments is 3,05,000. Divided, the fixed charge coverage ratio is this. That means you are seeing that how much your company is earning to pay the total fixed charges. So your company has 4 times the capacity to pay this fixed charges. It's excellent thing. Okay.
Okay. Right.
That's
Do
what
we
it
have
is.
one more problem like this?
In this book we don't have. We have to check.
Okay.
In this book we don't have. However, we have planned now one day we will sit and we'll do a long session on questions. So we'll pick some 10 questions from each part. I'll take 10 questions from solvency, 10 questions from the market ratios and all that. So I'll just plan it. Sorry?
It would be kind of a revision.
It would be kind of a revision. Yes, yes, yes. In this week only we'll do. Okay.
Okay.
So finish this one, Suman?
Yes, sir. Yes.
Yeah. So so tomorrow we'll take cash flow to fixed charges, and there are more 2 ratios which I have to explain you. So tomorrow is the conclusion class. It will take 30 minutes for all this, and rest of the 30 minutes we'll try to do some questions. Okay.
Okay.
Yeah. Tomorrow itself. Fine.
Okay.
Yeah. I'm just calling you, Suman. 2 minutes.
Okay.